Over 3,000 employers are contravening the Pension Funds Act, and this is according to the Financial Sector Conduct Authority. It found public and private sector entities are in arrears of about 7 billion rand. So for more on this, we are joined now by the authority's Takalani Lukhaimane, who joins me this morning to take this conversation forward. And thank you so much, Takalani, for your time. I mean, that number quite worrisome. What has led to not only that increase in terms of employers not complying, but the compliance itself, or at least the lack of?
Thank you so much for having us on the show to talk about this very important issue. The non-compliance is a combination, especially for specific sectors. You would have seen on the list, a lot of them are very small employers that are in the security industry or in your clothing industry, in bargaining council arrangements, where it is not necessarily a voluntary arrangement that they join, but they're compelled to join either by a sectoral determination or a bargaining agreement. And that already gives you, the will and the compliance is already less because it is not a voluntary arrangement by the employer. But these are also employers that are very susceptible to economic changes. So if there's the slightest change in economic environment where it could be load shedding, where they can't produce more goods and services. If you think about your clothing industry, if you think about your electrical contract cleaning or anything like that, they're very susceptible to small changes in the economy. And the economy has not done well. Over COVID, a lot of people lost their jobs, and some employers, small employers, just did not make it back. And that's why we've got a lot of employers as well, over 20%, that are sitting in our in our 5 to 10 years where contributions are outstanding.
And we're talking here about, Section 13A of the Pension Funds Act, 1956.
Yes.
What does it specifically prescribe?
The Act prescribed, or that particular section states that by the 7th of the month for which contributions are due, so if contributions were due for April, by the 7th of May, contributions to the retirement fund that the employer has deducted from a member's salary must then be transferred into the fund's bank account. So these employers had not contributed timeously, so they had not contributed by the 7th of May. They had not contributed to the retirement fund, although in terms of the rules of the fund, they were required to contribute and contributions were expected by the retirement fund. And so we took the cutoff date of 30 April to ensure that we could work on a particular date. And so we've got employers as at 30 April. Some of them, it was 1 month that it was outstanding, but some as far back as 5 years, as at that date, had still had contributions that were outstanding as well.
Yeah, we're also talking here 3,262, the number of employers that have contravened this act. So, Takalani, what then are the consequences of contravening this act as an employer?
Immediately once we're talking about the 8th of that particular month, late payment interest starts to accumulate. So an employer would have to pay what they owe together with interest, because if you had contributed timeously, the fund would have been able to invest that money in order for your retirement fund savings to generate some return. So the Act prescribes that the fund must then immediately start levying interest from the time that you are late until the time that you make payment. The members must be informed that the employer had not contributed. Our office must also be informed that the employer did not contribute. But over and above that, the Act makes it a criminal offense for you to deduct contributions and actually not pay them over. So in terms of a conduct standard that we issued last year that became effective now in February, retirement funds are actually required to then go and open a criminal case against an employer once those contributions are outstanding for more than 90 days.
And this is important information to share because when the contributions aren't timeously, made, it affects the members' retirement benefits, right? So this is a direct impact on the members.
It's a direct impact on the members, and the longer the contributions are outstanding, the more the damage. You can imagine in terms of retirement fund arrangements, in some cases there are benefits, there are other benefits that are also part of those contributions. So a death benefit, that would be a portion of it, a premium would be paid to an insurer. Now, if the insurer doesn't receive that premium, then that policy will lapse. So if an employee were to pass on, an employer or an insurer can actually repudiate the claim and say they had not received any contributions and therefore that payment is not due. Even for disability or where there's a funeral scheme arrangement, if contributions are not received, you also run the risk of losing those risk benefits from the insurer, since no premiums were made from the contributions.
Yeah. When we talk about employers in this context, we're not only talking about private sector, right? Also, municipalities seems to be, one of the culprits when it comes to non-compliance in this context.
Yes, employers or municipalities are also part of the employers in these funds. We've got a few municipal funds. We did engage with them because we had seen that on our list of non-compliances, we had approximately 1 billion that was outstanding from municipalities. And we did hold a webinar with them last year to try and make arrangements for how can we assist in this space. And the engagements are continuing to ensure that municipalities also catch up, because like I said, the consequences for death benefits, for retirement savings, if a member was to retire now, they're retiring with less than what they should have if contributions had been received.